Good day, everyone, and thank you for joining us. We're glad that you could be with us. This is Jason Lisui, and I'm joined by our CEO Jeremy Fair and Portfolio Manager Paul Vendrinsky. This will be our last webinar for 2020, and what a year it's been. Not sure if we've ever seen another time like this. So I'll be talking briefly about the importance of time as it relates to investing, then followed by a fund update from Paul, and then finally, as always, a market update from Jeremy. Just a reminder, if there's any questions, please feel free to type them into the question box and we will certainly address them at the end of the presentation. So, the holiday season for many is definitely a time for reflection when we look back over the year and contemplate what's transpired, and then we look forward in anticipation of the coming year. It's also a time to reflect on what's most important in our lives. For many, this is family or marriage or their health. And at the end of the day, I think one of the greatest gifts we receive each Christmas that we might not fully acknowledge is really the gift of time. And if we move to the next slide, time is a critical component within the investment process. And this is a chart that I showed back in May, and I've updated it to the end of November. This chart illustrates the importance of risk management as it relates to time. Here we're looking at the S&P TSX Composite Index over the past 20 years. And if an investor was unlucky and just happened to invest at the top of the market in August of 2000, roughly 20 years later in March of 2020, the index was at the same price level. Another example, if someone invested at the top of the market in June of 2008, roughly 12 years later in April 2020, the index was again at the same price level. The consequence of these large drawdowns was lost time. So why is it so important to effectively manage time in your investment process? Because ultimately capital can be regained, but the loss of time cannot. And the less time you have until your retirement, the less room you have for error. In our opinion, managing large drawdowns is the key to reducing the effects of lost time. And so this begs the question, how do you attempt to manage these large drawdowns? At SIA Wealth, we utilize an investment strategy called tactical investing, which is an approach that shifts the percentage of assets between equities and fixed income to adapt to the changing market conditions. For example, during large declines in the equity markets, having the ability to overweight fixed income could potentially safeguard your client's portfolio. And then having the ability to overweight equities when the markets recover could provide opportunities for growth. At SIA Wealth, we believe we've taken this approach one step further by expanding the flexibility of our asset allocation shift to a range between 0 and 100%. This unconstrained mandate with maximum range flexibility is what we're calling true tactical. This ability to shift our equity exposure between 0 and 100% is really aimed at helping to reduce the risk to your client's overall portfolio during times of heightened uncertainty in the markets. And one of its primary goals is to more effectively safeguard everyone's most valuable commodity, i.e. your time. So given that numerous equity markets are again reaching all-time highs, now would be a good time to reflect on the time component of your client's investment process and determine your plan of action to ensure this valuable commodity is not wasted. We will be introducing our true tactical concept to the advisor community in the coming months with materials to help you communicate this approach to your clients. So stay tuned for that. For now, I'll turn it over to Paul for his fund update.
Thanks a lot, Jason, and welcome everyone. Thanks for joining. Sorry, I was muted somehow there. Again, thanks everyone for joining us here today. I'll go over what took place in our portfolios that we sub-advised for BMO through the month of November. And speaking of true tactical, that's really the story for November. On the next slide here, you'll see a snapshot as of November 30th and what took place in a lot of the portfolios. And first of all, November was definitely an active month for stock markets on a global level. We saw the end of the US election, and then COVID came back and discussion on COVID vaccinations, and into this month, the rollout on again, a global level. And what this did really was spark throughout November and even towards the end of the year here, significant rallies, both in stocks and commodities. And, the story kind of went from investors looking past short-term lockdown risk toward solutions that might come from the vaccination solutions, what might happen here going forward. So it has been very bullish, and within markets, we've seen a real sector change in rotation from what we saw over the last number of months from leadership in stay at home or work at home kind of stocks, which included a lot of technology and a lot of communication sectors. Movement out of those, maybe it was profit taken, but a shift from those sectors to other areas such as energy, industrials, and a big shift has been into that consumer discretionary groups. So keeping with that true tactical approach that Jason was mentioning, we definitely made a number of shifts in a number of the portfolios, exiting from relative weakness based on our rankings to obviously relative strength. And again, that went from those stay-at-home tech, a lot of communication number names, to the consumer discretionaries. So to give you a few examples on some of the changes that took place on a broader basis, if we look at what changed within the bond portfolio, the asset allocation portfolio, and the equity portfolio, we can stay on that one for one more second. Just to give you an indication, we saw some changes on a broad sense. So in the equity fund, we sold the U.S. home construction name and replaced it with the global clean energy name. That was within the BMO equity fund and the BMO asset allocation fund. The U.S. home construction was replaced with that global clean energy. Now that was the holding that we held since moving back into the markets on April 30th, and we saw a 38% gain. So that was strong. Also in November, in the equity fund and the asset allocation fund, we sold that cap materials and purchased the global consumer discretionary ETF, and we saw a gain on that by about over 5%. Now I'll just take a look at what took place within our two focused equity strategies. So first here, the SIA focused North American equity fund. A big change that took place on top of what I was just saying for the sector rotation was a lot of movement out of the US equities into Canadian names. So as it shows here, as of the end of October, if you were on our last call, we only held 3 Canadian names out of the 15. At the end of November, that moved to 6, and as of right now, we're at 7 Canadian names. So the beauty of this product is that it does a lot of the thinking for you on a currency hedging or a currency changing ability, where we saw the move out of US into Canadian names. And not only is that sometimes influenced by the currency, but also what's taken place probably or possibly on a fundamental level in Canada. So it takes that natural shift done from a Canadian perspective, Canadian investors' perspective, and a Canadian dollar perspective. So whether we're seeing a fundamental shift or not remains to be seen, but that's the beauty of this product here. So a lot of times you don't know what's going to do better, Canada or US, or currency adjusted. It adds a lot of uncertainty into the decision-making process, and that's what this fund has been able to do, especially as a sleeve within a diversified, balanced stock portfolio. You can see here we're fairly diversified, and obviously this is at the end of November, but looking into where we're at now, we're actually positive on the year and have shrunk that gap between the benchmark even more so. Speaking of Canadian names, the next slide here gives you a snapshot of what we hold and how the focused Canadian equity fund looks like as of the end of November. And one thing you can see is we're very diversified. We're definitely outside of the traditional banks, metals, mining, and energy. We have exposures to energy and materials, but also utilities, real estate, industrials, and consumer discretionaries. One of the main sectors you see that we don't own at this time are any of the Canadian banks. So it's a very diversified holding, and this has always fit in very well with as a sleeve within an existing Canadian portfolio, especially one that might correlate more to, say, the TSX 60, and adds as a bit of a tactical sleeve for that. One thing I was going to mention, you should have probably already seen our commentaries for the month of November. If not, you'll find it on our landing page for the BMO funds, or contact us directly. Gives you an update on what's changed, what were our contributors, what what might have not played out so well, but gives you some real good speaking points for your clients. And speaking of that, we've been asked to kind of give some updates on some of our holdings. So the next couple of slides, I'm just going to give you a couple of stocks that we do own in the various portfolios, and just some talking points in case you weren't familiar. So the first one, we'll just talk about Caterpillar. It's something held within the North American Equity Fund. It's something fairly new into the portfolio, but you can see here, looking at the chart, pretty much why we do own it. The chart, obviously, recently, or for the bulk of the period from mid 2020 on, it's upwards to the right. So it looks strong. We're seeing key resistance levels around that $170 level. But if it happened to break through that, you could see that we're seeing a lot more movement to the possibility to that 200 range. So this is in that industrial space that has been strong, especially in the last couple of months with the breakout after the US election and what's rolling out with the COVID model. The next slide here, Charter Communications, I believe, is another holding within the North American Equity Fund. And now this is something we purchased quite a while ago. We bought this when the SIA charts equity action call went back into the green. We got back into the markets at the very end of April. So this is something we've held since then. So what would that be? Almost 8-9 months. The position's up about 20%, but we still like it because coming up to the current resistance level around that 650-ish mark, a breakthrough that could open up the doors to the 700. But again, this is our relative strength analysis. We don't look at one-offs like this, but we just wanted to give you a picture of something we hold, and picture tells the story here, and you can see definitely it's on a positive trend, and hopefully it continues. And last but not least, just as a snapshot holding within a couple of the portfolios actually, is Ovintiv. OVV on the Toronto Exchange, also trades in the US. It's been on a tear with the energy sector. Current resistance, and I should mention this is a relatively new holding, something we picked up in November, but the resistance at that 2021 level, 2051 to be exact, if that breaks, we could see room for further gains, possibly up to that $28 level, where there's going to be a fair bit more resistance. Break through that, sky's the limit. But investing in Canada has been a strong sector. The Canadian market for November as a whole was up about 11%, and that's what we saw within that Focus Canadian. It's been, for November, the strongest sector being up around 11, the MSCI on a broader global 10, and the S&P was around 8. But we're going into the end of the year strong, and these are just some examples of other positions we hold. At the end, if you want to ask about some other trades that took place, there was plenty. We can go into more detail, but for the time being, I'll turn it over to Jeremy, who will look at some of the broader markets and indices that we follow. Thanks a lot.
Thanks, Paul. Thanks, everyone, for joining us today. Certainly, 2020 has been a very, very interesting year. With what we saw with the COVID outbreak after a very, very strong start to the beginning of the year, and then the subsequent intervention that has been unprecedented, both on a central bank and a government situation. So very, very interesting. I'm going to start our update today, as I did last month, talking about COVID-19 cases. They continue to rise. We've actually seen in the UK, there's been a reduction and then subsequent increase again in numbers. The US is starting to roll over. Canada is starting to flatten out. So there are some signs that these closures that have been happening across society, states, and cities are starting to have some effect. So we'll probably won't know greatly until next month, and then we'll see how everyone treats the Christmas holidays as far as that goes. The closures have certainly got great publicity for smaller businesses, those moms and pops that are out there, or those mid-sized companies that we all shopped in before COVID. Those ones stand and continue to stand a tremendous risk of going bankrupt or not returning after COVID. But the upside, I suppose, for our industry is that most of the companies that are publicly related are doing just fine. They seem to be getting back, and there's a lot of forecast that post-COVID, post the vaccines, that we're going to have continued strength in them. The other major topic is the U.S. election and then the stimulus. The election has really been called in favor of Joe Biden. Some of the top Republicans are acknowledging the fact that Mitch McConnell, for example, is urging the GOP senators not to object to the election on January 6th. So seems to be a little bit more stability with the election, which is certainly going to help the markets one way or the other. Whoever wins, that's obviously certainty, is going to give the markets more confidence. That's great. The stimulus appears to be creeping forward, starts to be taking effect. So some of the rhetoric around the political parties and the election seems to be losing steam. The markets again are rallying as of late since the last month. We've seen strong gains, and we'll get to those later. And a lot of that has to do with some of the consistency that's coming in with the election results, as well as what's happening with the stimulus coming into the United States, which was really largely the only country on earth where stimulus was being held back by opposition of any kind. If we look at the equity action call, our top level of analysis, we can see that it's glued right to the very top. So this has moved up since our last update I guess in early November, late October. We've seen it move up to the very top. This again is representing that strength. What's more important about this is that we've seen the breadth improve. We continue to see the breadth improve. Certainly the conversation around vaccinations and now their subsequent deliveries even into some of the Canadian provinces is adding fuel to the stock market fire of upward movement. So we're at the top of our green zone. Investments in equities is clearly the place to be when we're in that situation from our point of view. The asset class rankings, our second level of analysis, has not changed. So we've got October 27th, we've got November 17th, our last update, and now December 15th, where there's been no changes. But what's very important about this is that international equity, US equity, and Canadian equity still remain the top three. We have seen some closing of the gap there, certainly on the Canadian side towards the US equity. This is largely coming on the back of US dollar weakness rather than Canadian equity strength, but we'll take it whichever way we can here. Cash, currencies, bond, and commodities. We see cash and currencies. So bonds rank sixth, continues to be weak, certainly an area problem, and we still see, at least within Canada, continued purchases by the central bank of fixed income products to support that market. Commodities, we seem to be having areas of strength, but not broad-based across the commodity market. So, but again, those three top equity asset classes at the very top of the list is very, very bullish for securities, and we're going to act accordingly with our portfolios. The SIA charts, market equal weight index. So this is our top level. This is amalgamating the activities of international US and Canadian equities into an equal weight index. We see continued strength here. We've moved up about 4 boxes since the last update, taking out near-term resistance. So that was good to see. Support is now sitting above 81,506, and this would be, if it happens, the first negative chart signal since March. So it's been a long time since we've had any bearishness in this index, and that continued breadth widening is helping this index rally, and it rallied quite a bit. So we do see resistance at 91,879, but there's strong room, plus or minus 12%, still upside left 15%. Left in the market till we hit our price objective on here. So on a risk reward, equities broadly based appear to be good. And so again, just reflecting what we're seeing in our equity action call and our asset class rankings. The NASDAQ composite, certainly one of the strongest benchmarks out worldwide, has moved through resistance at that 12,292 level. That's happened recently, so that's good news for US equities. It's got room now up into that 13,500 range before its next test, but the price objective is actually quite strong on a technical basis. This is a very, very bullish pattern that we just completed here, so there is potential upside beyond that. Support sits relatively nearby, 11,583. Again, that would be considered a key support level, showing us potential short-term weakness that could grow into something greater. So when we have strong bullish signals like this triangle that just finished here, a reversal could be seen as relatively negative. So we'll keep a close eye on that. But overall, a very strong chart. The S&P 500, not dissimilar to what we saw with the NASDAQ composite, just finished a strong triple top breakout. So this has happened since our last update, above 3,600. This gives us room into that 4,000 range. I apologize for my typo there, missed a zero. It continues to be a leader. That additional breadth that I've talked about in this update and the previous updates continues to show and provide greater opportunities for the S&P 500 as it has more industries and sectors in it than other benchmarks there. So support, again, we'll be watching this closely. If we see a move below that 33.92 level, that would be the first bearish chart signal that we would see on the S&P 500. The S&P TSX Composite, as we see within our asset class rankings, Canada ranks below the international and US equities. It's lagging other world benchmarks, but it is approaching key resistance. So we haven't got quite back up to those levels that we saw pre-COVID, but we are within a box of getting up to similar levels. It's at 18,121. Is key resistance. That would provide a new high for the benchmark, which would be important if we're going to see continued strength in the Canadian marketplace. But it still seems to be a little bit narrow. If you're going to be investing in Canada, as we have, you're going to have to be specific. And I think Paul highlighted very well where those strengths were in the sectors that are out there. Those traditional sectors are not doing that well. The one exception, it still hasn't reached as a sector basis up into the green zone, but energy has been improving, and we see that with names like Ovintiv, which Paul brought us earlier. When we look at the sector rankings, I think we didn't see tremendous changes over the last few months. We do see internet has moved back up into the green zone from the 10th position over the previous month. Everything else has really stuck around. What's interesting though is that we see health services move out of the green zone, has moved down into the yellow zone. So I think that's important. This might be a little bit of sell on miss or buy on mystery and sell on history as we move into the vaccination phase, that a lot of the gains from health services are starting to be priced in, and their relative strength has weakened as people rotate into other areas. Metals and mining continues to deteriorate. It moved down a bit more, went into the red zone since our last update. So it was a very, very strong area, seems to be weakening a bit. We'll have to watch that closely, considering its ties to some of those industrial names that we talked about earlier. Longer term weakness continues in banking and financial services. Again, two of those sectors that we traditionally see have tremendous strength, especially in strong economic times, just haven't been there. This is probably related to significant loan loss provisions, et cetera, that'll be happening in the financial services business once we get past the mortgage deferrals and some of the other funding that's coming from central banks and governments around the world. Energy, which I mentioned a moment earlier, has moved from the 30th position up to the 19th position. So I think that's an important one to watch. Certainly been in the penalty box in a green world, and lack of consumption being seen globally on potentially lack of economic activity. That seems to be changing materially here. We'll keep a close eye on that as well. So on that note, I did want to show crude oil. It has moved up quite materially. Since our last update, we've seen it move up in past its downtrend line. This is a very important indicator for me, especially since it comes with a triple top. So it's not a very common indicator, and I tend not to spend a lot of time on chart signals here, but that is a very, very bullish signal. So one of my all-time favorites is that triple top going through a downtrend line. I've seen that many, many times in my career over the last 20 odd years. Has proved to be a very strong indicator of future strength. So we'll watch that closely. Resistance is sitting at that 51.87 level, room to $60. So if I was to put a price objective on crude, it would be in that $60 range over the next little while. Support sits at 43.40, and again, would be watching that to see any material reversal, but I would look at that 40.90 range, the second support level, as a failure of this bullish signal that's showed up here recently. Copper, I had to bring it up again today just because it moved through resistance at 315 and then plowed right up into pushing against its upper resistance, which was 362. So that's great news for us on the economic side. Copper is really seen as a barometer for economic growth. So we'll watch that 362 level to see it broke out. Beyond that is $4, which is up in its highs back, going as far back as 2012. So we'll watch this closely, but it had a strong month since our last update in November. So that's important as well. Here's a list of all of our funds. I'll turn it back over to Jason for Q&A.
Great, thanks, Jeremy. Thanks, Paul. And just a reminder for everyone who, anybody has a question, please type them into the question box and we will address them as they come in here. I do have a question already that came in. Paul, maybe you can address this. The question was, looking at the BMO lineup that we sub-advised for BMO, some of the funds have lagged behind their index or their benchmarks. Could you provide some reasons for this? And before I let you answer, Paul, I'll just jump in just from a high-level perspective. So obviously the story was really March and April this year. I'll let Paul get into more specifics there. But from our standpoint, I think what's important to understand about our strategies and where they fit in portfolios is really the role that we play in the portfolio. So for example, what I mean by that is that in March, we were in a position of safety during what we saw then as extremely risky time in the market. We were in fixed income at the time, and then we obviously had some intervention that happened, and we have a very, very strong April. Well, we were in safety during that time, and so we're going to underperform that period of time. That's when we would expect to underperform. But I think the more important question is the role that we played is what we designed our funds to do. In periods of extreme uncertainty, we want to be in a position of safety so that the rest of your portfolio can be positively impacted by what we're doing in our fund. And so for us, we're happy with the response that we took in March. Yes, we understand what happened in April, but really the rest of the year was not that bad. I'll let Paul speak to that, and that was really that 1 month there. So, Paul, can you address maybe more specifics about the performance year to date?
Sure. Yeah, and you gave some good points, Jason. One thing I'll note is that early in January, we're going to get some bullet points, really speaking points for you to help talk to advisors. But as Jason mentioned, 2020 has been a year of massive uncertainty. And from our point of view, and from what we've done in most of all of the funds, has been the process of risk reduction. And this took place significantly within March and April. There was a lot of uncertainty, not knowing what may or could come out. If you've seen that slide we've used in the past, the momentum with a floor, it kind of tells a story. There was a lot of what ifs. We didn't, like, what if the central banks didn't come in? And thank goodness they did, and then we went back in. So for that period, we definitely played defense for that period based on our relative strength. Analysis, of course, it got us back into the market at the end of April, and then it was a game of offense. So since then, we have been strong, but we're still playing a bit of catch up from what happened in March and April. But that was obviously purposely done. But if you look at the portfolios from a risk to reward basis, we've done exactly what we've always promised as far as that tactical change. And the portfolio at the end of the year really is something that's given exposure to the equity markets, but on a much lower risk or lower volatility basis, as well as a higher Sharpe ratio. So again, as I mentioned, we'll have some more details on that. And we are playing a little bit of catch up, but as you know, as we are closing in on the year, we are for most of these in the positive, and again offered the end investor something to gain exposure to the broad equities markets most of the time, but also at a lower level of risk. Hope that answered your question.
Thanks, Paul. And another question for you here that came in. Can you commented on a few of the trades across our lineup? Could you comment specifically on some of the individual stock trades recently within the Focus Canadian and the Focus North American funds that we manage?
Oh, sure. Yeah, I guess I mentioned some of the trades that were implemented using our ETFs. Some of the individual stocks, now this would encompass, the 5 stock holdings within the equity fund, the asset allocation fund, or the Focus Canadian or Focus US. So I'll give you kind of a rundown because there was a lot of turnover. In November, I said we rotated out of a lot of technology. So that included Apple, PayPal, Microsoft, Amazon. Some of the names outside of that, we sold Danaher, Thermo Fisher, Lowe's, Agnico Eagle. Some of the stuff we bought and replaced, I think this would be mostly in the North American fund. We bought Ovintiv, something we talked about as an individual. We bought Target, Caterpillar, Canadian Tire, Magna, Canadian Pacific, Gildan, and GM are stuff we own now. So that was all stuff that took place in November. Not as much in December in the North American, but we did sell Home Depot and move into the Lightspeed. So that's one of the moving from the US into Canada. Some notables within, I guess, ZFC, that's the Focus Canadian. We sold a TMX Group, BRP, sold out of Ritchie Brothers, and moved into First Quantum, Northland Power, Brookfield Properties. And then in December, the Canadian sector, the Canadian markets were a little bit more active. We sold our position in Canadian Goose, Granite Real Estate, and then ended up buying into Alphria, CAE, Air Canada, believe it or not, as well as very recently into BlackBerry. So some old names, but yeah, been a lot of rotation. So those are just those are pretty much all the trades that took place in the stocks. It's been more volatile than usual. A lot has happened because of that rotation that we talked about in some of the sector names, but there's a summary.
Great, thanks, Paul. And the final question then so far coming in here, I'll pose this to Jeremy. Jeremy, can you provide your thoughts about what a Biden presidency might mean for the U.S. equity markets going forward?
Sure, it's a great question. I think that it's not going to be as it won't create as much change as people might think, given the Trump presidency and some perceived problems and antagonistic issues with there. Outside the texting, I think it's going to be fairly pretty much the same. A bigger test will be when the 2 Senate races next month are voted upon. If the Democrats get full control of the Senate, that certainly can be more material. But as it sits right now with Biden, I think you're probably just going to have, a similar situation. He has at least recently voiced similar concerns about China and how he's going to deal with China. If those continue on in the Trump fashion, I think the rhetoric will be less antagonistic, but the actions that are happening will be there. In the economy, there's certainly sectors that will do better than others, but I think that's going to be more related to what happens in that Senate race with the Democrats, because if they try to do much change on taxation or the Green Plan, a lot of that won't make it through Senate on a Republican Senate. So we'll have to wait and see how that Senate race goes. But until then, I think the key part about it is the stability about knowing who's won the election, whether you're a Democrat or a Republican. The stability that comes to it, the market is certainly very interested in that, and then not very interested in court battles over it. So we'll see how that goes going forward.
Great, thanks, Jeremy. And it seems to be all the questions we have for today. So again, thank you to everyone for joining us today. We will be back in mid-January with another monthly update. Until then, Merry Christmas, Happy Holidays, and a Happy New Year to everyone. Take care. Thanks again.
Merry Christmas, everyone. Take care.